Are you wondering where to invest your money, but don't have the risk tolerance or the time to research individual stocks? In this video, I will share with you my top 3 ETFs that can help you grow your money with less risk than individual stocks. Hey everyone, it's Juan here. Welcome back to my channel. If you're new, bienvenido. I recently started this channel which will focus on investing and money topics. I am originally from El Salvador, but live in the US, and my career has been in finance. So I bring a unique perspective to the topics I discuss. If this sounds interesting to you, please consider subscribing and smashing that like button, as this helps me tremendously in creating more content for you. Also, stick around till the end of the video for my bonus ETF. With that, let's jump into it. So the first ETF I have for you guys is the iShares Core S&P 500 ETF, ticker symbol IVV. Now, stepping back for a second, exchange-traded funds, or commonly known as ETFs, are funds or pools of money, like mutual funds, that invest in a group of stocks, but unlike mutual funds, they trade like individual stocks. So my first ETF, IVV, invests in large US companies that make up the S&P 500 index, and the ETF has 505 holdings. You know, I like this type of ETF because it is a way to diversify into the stock market, right? And these types of ETFs are also known as not only core, but market ETFs or index ETFs, right? In this case, so this ETF has the top 5 holdings, which you will recognize. It's Apple, Microsoft, Amazon, and Google, right? It also has a very low expense ratio of 0.03%, which is basically $3 per every $10,000 that you invest. And it has done really well over the past 10 years, returning 15% annually, and then 7% annually since inception, which was back in May 2000. This, I think it's a great ETF for beginner investors to consider because it's diversification and also the low expenses. Now, the best way to invest in this ETF, in my opinion, is to set up a schedule to invest either monthly or on a quarterly basis over a long period of time. So here's an example. If you invest $1,000 per month with an initial investment of $1,000 as well, and a rate of 7%, which is what the IVV has returned since its inception, in this example, you can see that over 20 years, the projected savings is $600,000. Before I forget, feel free to check out the links in the description below, which have the calculator that I'm using for this example, and also fact sheets for the ETFs I discussed on the video. Also, I would suggest you play around with this calculator to tailor it to your financial situation, as you can change, your investment schedule, the time to grow your money, return rates, initial investment, etc. Now, the second ETF I have for you is the Charles Schwab Dividend Equity ETF, which the ticker symbol is SCHD, and is geared towards investors looking to have an income-producing ETF. As the name describes it, this fund focuses on companies that offer a dividend and tracks the performance of the Dow Jones US Dividend 100 Index. This ETF is not as diversified as the one that I was talking before, the IVV, since it only has 102 holdings versus, remember, 505 for IVV. However, the top 5 holdings in this ETF are Merck, Home Depot, Texas Instruments, Broadcom, and Amgen. The expense ratio is higher than the IVV at 0.06%, but it's still a good rate, still a good expense ratio. And it has returned about 16% annually over the past 5 years and 15% annually since its inception back in October 2011, which that's pretty comparable to the IVV ETF. Now, the important part for this ETF is that the current dividend yield is 2.8%, which is a fantastic yield compared to the highest banking rates available. Currently, the highest savings account that I found was 0.6%, and the highest one-year CD rate was 0.7%. So, compare it to 2.8%, that's huge. Now, I have a random question for you. Do you know how many ETFs are available to invest in? I'll give you a second to think. Ready? It's 2,000. When I saw that number, I thought it was wild and overwhelming. Can you imagine going through 2,000 ETFs? By the way, what is your favorite ETF? Let me know in the comment section below. All right, my third pick is from another type of ETF called sector ETFs. These ETFs invest in companies focused on an individual sector, like industrials, financials, home buildings, energy, etc. My pick here is Fidelity's MSCI Industrial Index, ticker symbol FIDU. I like this one because of the exposure to industrial companies that may benefit from the infrastructure bill currently circulating in Congress, and to hedge against rising inflation that we're seeing. This ETF has 348 holdings, which is slightly less than the IVV and more than the Dividend ETF that we were talking about before. The top 5 holdings for this ETF are Honeywell, Union Pacific, UPS, Raytheon, and Boeing. The expense ratio is 0.084%, which is slightly higher than the Dividend ETF expense ratio, but it has returned 14.5% annually over the past 5 years and 12% annually since inception in October 2013. So it's comparable to the last 2 ETFs that I talked about. Like I promised, this is my bonus ETF. Thank you if you're still watching this video. You are a VIP. For you, I have the Ark Innovation ETF, ticker symbol ARKK. You probably have heard this ETF on the news. It's been very popular because of the fund manager. She's always out there talking about the fund. Her name is Cathie Wood. The performance for this ETF has been amazing over the past couple of years. It's up something like 86%, and then 48% annualized return over the past 5 years, and then 34% annualized return since its inception back in 2014. Now, this ETF focuses on high growth companies with disruptive innovation characteristics, and the top 5 holdings are Tesla, Teladoc, Roku, Unity Software, and Coinbase. Despite that performance, the ETF has not done well year to date. It's down about 5%. And a couple things that I would add about this ETF is that because of the types of stocks that the fund invests in, and also the number, which is a lot less than, it's less than 50 holdings, it will definitely be a more volatile ETF compared to the ones that I shared with you earlier. Now, here's a summary of the ETFs I have discussed, and feel free to pause right now and take a closer look at the pros and cons of each. One thing that I would note are the expense ratios. All the ETFs that I mentioned have a relatively low expense ratio compared to the average mutual fund expense ratio of 0.9% and the average ETF expense ratio of 0.45%. The only exception is the Ark ETF, which has an expense ratio of 0.75. Now, I want to put this into numbers and into perspective for you, and I'm going to use this handy calculator that I'm going to link in the description below as well, in which I'm going to compare IVV's expense ratio against the expense ratio for an average ETF. Now, looking at the chart on the screen, you can see that you are saving over $22,000 in a 20-year period when you choose a low expense ratio ETF. So definitely keep expense ratios in mind when investing in ETFs. All right, everyone, that is all I have for you today. If you enjoyed this video, be sure to like and subscribe. Also, feel free to leave me a comment or a question down below. And I'll see you in the next one. Adios.